Good morning, everyone. Welcome to this update for global markets for the 16th of July. And it was really a historical week in many ways. We saw the US S&P index break out to new all-time highs after 2 years of basically bumping up against the resistance level. And we saw strength in all the other indices and even in a lot of the subsectors as well. So there's no question that this move in the US is being extremely well supported. I have to note, however, that it completely defies valuation and logic, but that's another story. It just is, it is what it is, and we've got to go with the trends, as I've been saying now for quite a long period of time. We also saw continued strength in precious metals, which is really impressive. And so we'll look at all those things. So we'll start with the American stocks. The S&P higher by 32 points on the week. Sorry, just get rid of that. Sorry about that. So 32 points up on the S&P index. And we're basically into blue sky territory now, so there's no more resistance at higher levels, and the market is open to go as high as it wants to. There are several scenarios for how this might play out, and I'll go through those when I get to the chart. But as I see it, there's probably three different paths that the S&P index can follow now. We've still got this basic conflict, however, between risk-on assets and risk-off assets. Normally, investors are either risk-on or risk-off in attitude, particularly in recent years. It's been a bit like a light switch. There's not been a lot of grey area in between. You're either one or the other, and it flip-flops backwards and forwards fairly quickly. However, what we're seeing just in this most recent period is that risk-on assets, like stocks, for instance, are going up. But at the same time, perceived risk-off stock assets like gold, silver, and bonds are also going up. So, excuse me, that's sort of defies the laws of economics and logic, but markets just aren't logical these days. Now, the VIX remains below 12, which when you consider what's going on around the world with Japan and the UK and Europe and negative interest rates and China and all these amazing things that could blow up in our face, that the VIX remains below 12. It's really quite extraordinary. We saw through the week the US dollar also starting to move higher again, and that's largely because with so much of the world in negative interest rates on government bonds, particularly Japan and some parts of Europe, that money is fleeing into the States as just a means of getting a slightly better return. Now, they might only be getting about 1.5% for a 10-year US government bond, but 1.5% beats zero or even negative. So we're seeing a continual flood of money into the US, both into bonds and also into stocks. And I think that's perhaps part of what's driving the US stock market as well. So let's take a look at the S&P index. We'll start with the VIX actually. So here's the VIX index, and you can see that it's under 12, and it's basically at the lows of where it ever gets to. So we're here right now. We're right down. It never really gets any lower than this, and that's really quite extraordinary given what we've got going on around the world. I have no explanation for that other than the only thing that makes sense to me is that the large traders who would normally be insuring their portfolio against a downward move in the market now feel so comfortable that central banks have basically got their back, that central banks are not going to allow stock markets to fall, that people have just really decided to abandon the need for put insurance, which is really what determines the value of the VIX. So we are certainly in very uncharted territory, that's for sure. Now let's look at the US market. We'll go to the daily chart on the S&P and pan back, and you can see here that we had this ceiling that really started started forming in late 2014. and we've just had a series of rolling tops. We've had a couple of plunges, one in August, September last year, another one in January, February this year. But we've now managed, let me just put a line on that. We've now managed to break above those all-time highs, and you can see it was quite a run higher during the week. Just every session finished up on the day. So there's no blue sky above here. Now, the only technical conclusion that I can reach is that this is playing out as a normal Elliott wave pattern would play out. Now, I'm not a big devotee of Elliott wave by any stretch of the imagination, but I think there is some validity to the patterns because they do fit in with human psychology. This is the third leg, which tends to be the longest and strongest, both in terms of time and distance. And it started in 2011, ran all the way to 2014. A lot of people were calling this a top and that we would get a rollover and a new bear market. I think what's now unfolding is that this is a fairly complex wave 4 structure, which is just a consolidation. So just think of it as just another pause in an ongoing bull market. Now, the fact that it was pausing for nearly 2 years is consistent with the bigger picture because we had a run higher from October 2011 to April 2015. So 3.5, getting on towards 4 years. 2 years of consolidation or 18 months of consolidation, and then the next leg higher starts. And this should be the final leg before we then get into a major bull market. Now, as I see it, there are potentially 3 scenarios that could play out here. Fifth legs are incredibly unpredictable. They can be like the leg 3 in terms of time and distance. And so that's possible, just a steady grinding rise higher that could see the S&P up around the 2,600 points or possibly even up to the 3,000 point level. The other alternative is that this wave 5 is really quite short, quite truncated, and it doesn't go very far and it doesn't take very long to do it, as in, perhaps 6 months or something of that nature, and then the market rolls over. That'll probably be dependent a bit on what's happening around the world and what central banks are doing. The third alternative is that we get a repeat of what we had in the internet bubble in 99, 2000, and that's that we get stock prices just go parabolic. That central banks have just put so much money into the financial system that asset prices just go ridiculous, and people start piling in with a real fear of missing out. So the fear of loss flips over and becomes fear of missing out. And so we get this massive blow off that occurs over a period of anywhere from 6 months to 2 years, and that could just take the S&P to, pick a number, whatever level you like. So they're the 3 scenarios. We'll have a reasonable idea, I think, in 6 months which scenario is playing out. So that's the S&P, but for now we're in blue sky territory, and I would expect to see the index continue to move higher as much as that goes against everything in my head about valuations and fundamentals. It is what it is. Turning now to Australian stocks, the Aussie dollar was higher as commodity prices continued to move up a little bit. But it's mainly about the yields. The Australian yields, while they're very low by our standards, they are still quite attractive to people in Europe and Japan that are looking at negative rates or effectively zero rates. And so money continues to flood into Australia as it does into America. Now, there's a lot of other things going on in Australia, and we're not the world's reserve currency. So I still stick firmly to my view. The Australian dollar is in a long-term downtrend, and all the fundamentals are against the Australian dollar staying at this level. The RBA will be forced to cut rates if the Australian dollar moves any higher, I believe, because we're going to be in a lot of trouble if our dollar is not down in the 60s or possibly even in the 50s. So I think you're going to see some action from the RBA. So we finished the week at 76. The ASX 200 had a big week, up 200 points, and finally broke the 5,400 barrier that people have been talking about seemingly forever after 12 months of trying to break through. Now, there's still many factors against local stock performance. So this remains absolutely a stock picker's market. I don't think you should be doing any kind of broad brush trading or investing, thinking that the tide is going to lift all boats, because I just don't believe it's going to happen. There are too many things against many sectors in the Australian market. Let's take a look at the Aussie market. So there we go. We've had this 5,400 level has been in place now since August of 2015, and we just managed to peep above it on Friday, finished at 54.30. So we'll see what happens next week. Of course, this could just be a false breakout and we could end up back in the range fairly quickly. The Australian banks, which are obviously a major driver of the ASX 200, I still think, whilst they're very solid as a business, there's a lot of things against them. So I just can't see the Australian banks running too far. Just while I'm here, let's take a look at precious metals. So we'll start first of all with silver. And silver broke this really, really important long-term, this is a really important long-term resistance level and support level around about the $19 to $20 mark. You can see that it roared up there a couple of weeks ago and has been able to hold that level. And it really performed much better than gold did on the week, because it held pretty much steady for the entire week. So we just continue to see this really impressive performance from silver with a strong move and then virtually no pullback. We're just getting a pause. This is gold. We finished down around $37 on the week. So a little bit of a response, but I think that was largely currency. That was largely about the US dollar moving up more than anything. The other indicators that I look for, the amount of money, the amount of gold that's flowing into the gold ETFs, all those sort of data points are still looking really solid. And there's the slightly bigger picture. You can see there on a weekly chart for gold, quite clearly it's been holding above this moving average level. It's clearly broken this downtrending wedge, and I think gold up above $1,500 is quite likely. And we're just emerging from one of the weakest periods of the year for demand. We should have seen weakness, particularly in gold stocks. We haven't, which is very telling indeed. So gold down by $37, really just related to currency. And there's been minimal selling of gold. There might have been 15 or 20 tons of gold sold in the ETFs from just under 1,000 tons. So it wasn't very much considering what was going on, the move into risk-on assets. You would have thought the selling of gold would have been far more concerted than it was. And the outperformance by silver itself and also by the silver stocks is very telling to me. Normally during a corrective period, you would expect to see silver stocks really amplifying any correction, and it's just not happening. And that really screams strength to me. Turning to other commodities, copper rose to $2.22, a bit of an unusual sign of strength because it's been quite weak for some time, but this is, I think, just part of the fluctuation that we're getting in all sorts of asset classes in the short term. Copper, as I showed you last week with the 5-year chart, remains in a long-term downtrend. Crude oil steady at 46, didn't do much. There's the copper chart. We managed to move up a little bit during the week, but still a big picture long-term downtrend. So just to wrap it up, and this slide is virtually the same as last week because I just think it's the most appropriate message that I can give you, and nothing has changed during the week. You've got to stay with the trend until it stops trending. If you were basing your trading and investing on logic and what you think the S&P index should do, then you would just be completely and utterly messed up at the moment because there's a lot of things that are just far from logical. So the best advice I can give you is to observe what is in front of you and respond to what you see. And you've just got to park your own preferences and bias and thoughts because it's really not relevant. I said last week that investors could raise non-precious metals exposure, and that's proven to be a good call because obviously the S&P broke out and the Australian market also managed to hit some new highs as well, or new medium-term highs. So yeah, that was quite reasonable in terms of timing. Now, the earnings season in the US is tracking okay so far. Alcoa started the ball rolling with a pretty good report. We saw some of the US banks that have probably reported a little bit better than expected. But look, America still continues to play this game where the companies and the analysts talk down the expectations, to sometimes even negative growth. And then when they beat them, even though they're really, really mild targets, then everyone cheers and says, how well things are going. We don't have enough data yet in this earnings season to say that that's the case again. But if the US dollar continues to move higher, which I believe it will, because there's just so much money coming out of Japan and Europe looking for a slightly better yield, that it's hard to see the US dollar not moving higher from here. There's just so much money looking for a home, and a higher US dollar, of course, is going to affect the earnings returns for American multinational companies that have a lot of their earnings from overseas. So that strong dollar doesn't help. Now, the low VIX index just absolutely flies in the face of what's going on in the bond market and the gold markets. There is clearly a level of fear and caution in those markets. The VIX index should be, in my view, given all the circumstances, should be somewhere between about 16 and 20. It's still sitting at around 12. And it also defies just what's going on in the European banking system, particularly Italy, which is absolutely on its knees. It's just a lot of things that don't make sense. Precious metals, overbought still. In the short term, and I've been holding off, waiting for a bit of a correction, but that correction hasn't come, which is a real sign of strength. And we're almost out of the weakest time of the year. So the long term really does look fabulous for precious metals. But as I indicated last week, trade management is not going to be easy. Even if things are going well and you're making profits, I know I get a lot of emails and phone calls from members asking me about various aspects of when to take profit, when to buy in, all those sort of things. So it is challenging. So that wraps it up for the week. Now, as you would probably be aware, I'm running an event in Sydney on Monday night. And the key discussion points, it's going to be a quite informal gathering, if you like. It's not going to be a sermon from the mount, I can assure you of that. What I want to do is to get a group together who's really interested in what's going on and how they can trade and invest better in this market. And so the key discussion points that I want to put on the table, but I'm happy to wander in all sorts of different places. I want to look at what events have brought the financial system to this point. And there's really about 50 years of history that I'm going to touch on just very, very briefly, just to scope it out so that you understand exactly what has brought us to this point and therefore how it's likely to continue. What it means for risks and opportunities over the next 5 years, because I'm just super excited about the opportunities. When markets get really volatile, it means that prices move further and faster than they normally do. And if you are on top of your game and you're on top of your game plan, then there'll be opportunities that we've been starved of for the last couple of years because markets have been so range bound. I'll be looking at some of the best opportunities that exist right now, and there really are quite a few. Um, even in ugly markets, and of course we don't have one of those at the moment, but even in ugly markets, there's terrific opportunities. And the other thing is just the key signs that I monitor that will give me plenty of forewarning of any changes in direction. Just a point too, this will not be recorded. So if you want to get access to this information, then and you're in Sydney, then you need to come along. The event details, it's at Northbridge Golf Club in Sailors Bay Road, Northbridge. I'll be starting at 7:30 p.m. sharp. If you could please make all endeavours to get there by that time, because I'm going to be starting with important information straight off the bat. And we'll run through till around 9 or 9:30, just depending on how much discussion people would like to have. So there is a link below this video for you to register. We do need you to register so that we can arrange the seating. So hopefully, people in Sydney, I can meet up with you on Monday night. There's my contact details for anyone else who's not in Sydney that would like to talk to me about improving their trading and investing performance. So that's it for this week, and I'll see you on Monday night, or I'll be back with you next weekend. Cheers.